What's up everyone, it's Scotty with MoneyVest. So in this video, we are going to be talking about one stock that scores really highly on our MoneyVest platform. So what we did is that we have built the M score, which is called the MoneyVest score. It assigns a numerical value to each company that you're analyzing. Over 17,000 stocks have an M score, and they're categorized by 5 different categories. We've got the growth, we've got efficiency, profitability, financial table, and of course valuation. So those are the 5 things that we categorize each and every stock with and assign a numerical value for every company. And this is one of those companies that is very, very high quality. It's a very high profitable business that I would love to have in my portfolio. It's just traded at a very expensive level for a very long time, and I would really also recommend for myself as a buy and hold company for the long term. This is a stock that you just buy, hold, and really just forget, because it's going to bring in a lot of gains in the future. So hope you all enjoy this video. And it's not Adobe, it is a SaaS company though. It is a company that has, again, incredibly high margins with a lot of great potential future here moving forward. So hope you all enjoy this video, find it helpful. Make sure you drop a like and don't forget to subscribe to the channel. Again, links to our Discord is going to be down below, including our 51% discount for the MoneyVest beta launch. That's a special pricing that we're offering prior to the beta launch, and you'll have early access to the entire platform, and you can lock this pricing in forever. So you'll never have to worry about the prices going up, regardless of how much functionality, features, and tools we add over time. So you're going to be locked in at that rate for life. So the company we're talking about today is going to be none other than Visa. And Visa here scores a nice 3.87 M score out of 5 here on our platform. And that just is one of the highest levels. And the reason I say that is because we've got a very, very strict, I should say, criteria for these companies. And I'm yet to come across a company that scores over a 4 out of 5 on the M score, because of how strict this criteria is. And I think a lot of these companies are failing on the valuation piece because they're so expensive, because the markets are trading at an all-time high, because a lot of them have moved up higher and higher, trading at all-time highs. They don't do very well on the valuation section, but everything else is phenomenal. Growth is good, efficiency, profitability, their balance sheet, everything is good except for the valuation. I think that's one of the reasons why a lot of these companies don't cross over that 4 mark. If I go over to NVIDIA, you'll notice that NVIDIA actually also scores better than Visa. It scores a 3.9 something, 3.93, as you can see over here. But even NVIDIA doesn't cross over that 4 M score. And the reason being is because of valuation, once again. So going back over to Visa now. So, Visa is a company that, again, is in the payment processing section. Obviously very, very high gross margin. So if you come down a little bit to our key stats table, what you'll notice is very high gross margins of over 80, almost 80%, operating margins of 67%, net margins of 53%, and EBITDA margins of almost 70%, and cash flow margins of 61 to 57% respectively. Relatively low stock beta, so it's not as volatile as the market, significantly less volatile than the entire market. Year to date is actually not doing that great. It's only at 5%. With a market cap of just over $500 billion. And I could see Visa, over the long term, getting up to that $1 trillion mark, because I feel like $1 trillion now moving forward is actually going to be a lot more achievable for a lot of companies, because we've got 3 that are now trading at over $3 trillion. We've got 4 that are now trading at, actually 3 more that are trading at over $1 trillion. 2 of them actually trading over $2 trillion. And a lot of them are trading between 500 billion and $1 trillion. So I think there's a lot of potential for a lot of companies to double and get up to that $1 trillion mark over the next 5, 7, and 10 years out. And that's exactly why I think it's really important for us to start looking at companies from a market cap standpoint. What's the potential? And Visa is one of those companies that, in my opinion, could get to that $1 trillion mark over the long term. Now, this right here is going to be that growth. So again, 3-year growth here, 14%. So it's actually a little bit higher than the 10-year CAGR of 10.5 and 5-year CAGR of just under 10%. Earnings per share, 3 years have grown 20%. This is a very, very high growth rate for Visa, right? 3-year growth rate of 20%. It's actually a growth company. We're looking at 14% growth on a 5-year basis, 15.6 on a 10-year basis, and free cash flow is also growing at over 20% for the company. And the good thing is that they're buying back shares every single year. So they've done a really good job in buying back shares by about 2% every single year, with expected earnings per share increase of 14.6% over the long term for the company over the next, say, 12 months here. Now, this right here is going to be the valuation. So it's actually not as crazy as some of the other companies out there. So we're looking at 30 times on a trailing basis, price to earnings, 16.27 on a price to sales basis, 28 times free cash flow, 26 times operating cash flow, 13 times book value, enterprise value to EBITDA 23 for the company. And balance sheet's also pretty strong, 1.4 times the current ratio. We got 1 times cash to debt. Net debt is also pretty solid. So in other words, negative number here. That means the company's got more cash than debt on the balance sheet. Debt to free cash flow is also low at just over 1. Total assets exceed total liabilities. Total assets also do exceed total debt for the company as well. One of the things that does concern me a little bit, and that is goodwill as a percentage of total assets, 49%. That is incredibly high for the company. So if we come over to our analysis on the MoneyVest metrics, what you'll notice is that it's got growth across the board for 3 years. Let's go over 7 years worth of analysis here. We've got growth across the board. So very nice checks. And it basically scores a 4.28 out of 5 on growth, which again is pretty solid. And if you come over here, you'll see that everything has done really well. The top thing is going to be the revenue. This right here is going to be operating gross profit. This right here, operating income. This right here, net income or free cash flows over here for the company. So everything has moved in the right direction. And you can kind of pick and choose what things you want to include on this chart. So let's say that I don't want free cash flow. I don't want operating income. I just want to take a look at revenue and profits. And again, every single year, they've done a really good job in growing those two numbers with very high margins as well. Speaking of margins, you can include for gross margins, operating margins, net margins. And now you can see that they've been more or less stable for the company. And that's exactly what it says. However, 2023, we did see gross margins coming down slightly. So they've actually gone from, about 82% down to just under 80% with an average of about 80%. So that's why it says a little bit compression here for gross margins. And we got operating margins that are relatively stable. However, net margins are expanding a little bit. So that's good. They are increasing some of the net margins here, 52% compared to the average of 47.7 and also 35% back in 2017. So profitability most certainly is increasing. And we also got operating cash flow and free cash flow margins also going up with that rapid expansion coming in for Visa. Now, if you scroll down a little bit further, and by the way, they score a 3.67 on profitability, partly because of the gross margins coming down and operating margins and EBITDA margins somewhat stable and not seeing a lot of expansion, but still pretty decent number. If you come to efficiency, they score a 4 out of 5, which is again very good. They're very efficient to highly efficient across the board on a lot of these different metrics. 18.7% return on assets, 43% return on equity, 30% return on invested capital, and 32% return on capital employed. So all these numbers are much higher than their average 7-year average here. And like I said, if you come take a look at the stock-based compensation as a percentage of free cash flow, revenue, and a free cash flow, really, really low here at under 3 to 4%, which is again very good. So that is highly efficient business model for the company. So in other words, they're not giving out a lot of stock-based compensation at the moment. Now, this right here is something that we discussed earlier, which is goodwill as a percentage of assets, which is labeled as very bad because it is pretty high at 48, 49%. I'll also show you that in the fundamental charts in just a minute. Cash is improving, so that's good. It's increased by almost 8%. Debt is also increasing but at a slower rate at 3.6. And of course, net debt as of 2023 sitting at 1.5 billion. As of the most recent quarter, that number's come down a little bit further. Current ratio is good. Debt to free cash flow, all these things I already showed you in the key stats. And then finally, we arrive at the valuation section. But before we get there, financial table 3.38, partly because of the increasing debt, stable net debt, and then we've got very, very high levels of goodwill as part of the balance sheet as well. And then finally, if you come over to the valuation relative to its own average, right? So that's what this does, is that it's comparing to its own average. And then we've got a certain minimum and maximum values to also identify. But if I simply, include for price to earnings, price to sales, and then also include for price to free cash flow, and then let's just go over to price to, let's see, operating cash flow. Then we'll also include enterprise value to EBITDA. A lot of the valuations you'll notice compared to its historical average, you know what? We're going to remove for operating margins and we're going to remove, let's see. Yeah, so let's just include for price to earnings and price to sales as well. There we go. So now we've got a valuation which has been coming down a little bit. So as of 2023, we're looking at around 30 times earnings. This is price to earnings, and we got price to sales at over 16, which again is a little bit lower, but 23 was, back in 2020, price to earnings at over 48. So this is more like a baseline for the company here. If I were to kind of mark this number, this is more like a baseline, which is around the 25 mark for both price to earnings, and price to sales is going to be a little bit lower, closer to around here. So I would say it's trading in and around its average for 7 years. So if you come down, it does say that it's trading at a bit of a premium. Some of them are reasonable. So like, for example, enterprise value to EBITDA, reasonable. Price to operating income, reasonable. And then some of the other ones are slightly trading at a bit of a premium compared to their own averages. So if you go to the balance sheet, and we're going to be selected to quarter here, and let's just go over to the last 8 quarters. And what I really want you to focus on, of course, is the total cash, the company's long-term investments. So right now, $17.7 billion plus another $3 billion. So that's a little bit over $20.7 billion. And then if you include for long-term debt, which is $20.6 billion, that's when the company actually has a net debt, which is negative $192 million, which is what we noticed on the company's homepage. So over here, net debt says negative $192 million because it's accounting for the cash, short-term and long-term investments, and of course, the long-term debt for the company as well. So that's where we are. If you come over to Analyst estimates, they've got a strong buy on Visa right now with about 25 buy ratings at the moment, with a high price target of about 357, a low price target of 267, and we got an average price target of $316 at the moment. So even the lowest price target is actually very close to the market price for Visa. And if you come down to the expectations, Visa is expected to grow earnings from $8.14 to more than double to $17.44. And that's going to be a CAGR of about 16.5%. So that's going to be that number. And if you come over to the revenue, from $32 billion to well over $48 billion, and that's going to be a growth of about 8.5%. So we're actually going to be using 16.5% as a growth rate for Visa when we're doing our analysis. So if you come over to the analyzer and discounted earnings multiple model, and of course, just under $17 billion in profit for the company as of last year, compounded annual growth rate for the next 5 years, let's just apply about 16 here. Give them a P multiple. On average, they've traded about 35 in the last 5 years. Let's give them an average P multiple, or expected P multiple, of close to 25, which again is going to be a little bit lower. 10% margin of safety, 12% discount rate, and let's just do negative 2.5% in shared buybacks. If you hit calculate, the fair value is actually going to be almost similar to where the price is trading right now, just about a 5% decline needed. So $258 is going to be that intrinsic value with a sensitivity grid over here. Of course, the higher you go in the price earnings multiple, the higher you go in terms of that growth rate, of course, the higher you are going to be on the intrinsic value. But I think 250s is a very, very decent price for Visa. That's after accounting for a conservative growth rate of about 16% in profit growth. That's what analysts are expecting, and a 25 times P multiple, and a little bit of share buybacks of 2.5%. We arrive at $250 in the fair value for Visa. So in terms of technical analysis, it seems to be forming a bit of a symmetrical triangle. So you can see that it's just consolidating sideways in that range. Massive support here sitting in the 260s. So eventually, if it does end up, let's say, selling off and breaking down from the symmetrical triangle, I'm going to be watching this support right here as the most important support, and also aligned with my fair value. That's going to be sitting roughly at around, in and around the $250 mark. So that's right there is going to be that support level to keep in mind, with a massive resistance all the way up to $280 for Visa. So hope you all enjoyed this video and a complete update on this company. Let me know your thoughts down in the comment section below. And again, if you want to get access to the entire platform, to the MoneyVest beta launch that we're going to be having on July 8th, link's going to be down below with a massive discount of 51%. You can lock this pricing in forever and never have to worry about it again. So as always, happy investing, and I'll see you all in the next video.